All right, welcome back. I hope everybody got a coffee, something to eat, is refreshed and ready to go. When we went out and surveyed over 1,000 financial advisors, one of the biggest concerns that came back was, where are the markets going? How do I invest in these things? What do I need to be aware of? What are the opportunities? What are the risks? So we put together a panel of what I think is some of the best minds when it comes to investing. And to lead that discussion is CNBC's Bob Pisani. So Bob, if we could have you and your panelists come on up, we'll go ahead and get started. But let's give them a nice, warm Inside ETFs welcome.
Thanks, John.
I don't know if you
Thank
have
you,
slides, but just in case.
Am I going to sit here? Okay. Thank you, John. Always a pleasure to do this. I'm proud to say I was a very early supporter of the ETF business. This is going on 20 years. I think the first time I ever talked about the SPY was in 1999. I was a Jack Bogle disciple, still am, even though Jack has difference of opinion, rest his soul, on ETFs. Vanguard did not, and you can see what a monster Vanguard has become in this business. We want to talk today about trade wars, Brexit, and the ocean of debt that's out there, and how are we going to respond to that. What we want to do is try to give those of you who are out there, the RIAs of the world who have to go talk to their clients, some idea about what's going on in the world, and some idea about where growth is, or the lack thereof, about global growth this year. So we've got an all-star cast sitting here right next to us. Marianne Bartels, a longtime friend of CNBC. She's head of RIC and ETF strategy and global research at Bank of America Merrill Lynch. We also have Todd Jablonski here, as the CIO of Principal Portfolio Strategies out there. We have Urian Timmer. He's the director of global macro at Fidelity Investments. Jeet Podkaminer is the head of multi-asset research strategies at Franklin Templeton. And of course, we also have a friend of mine, Brendan Ahern. He's the CIO of Crane Shares, which is one of the major ETFs surrounding China. And we're going to get his views on China. Marianne, let me just start with you. You had an interesting comment in your note to me. You said the Fed's on hold right now, and there's a chance we can get the multiples to expand in the United States. I want you to expound on that, because I have a little bit of a problem with the markets right now. We've got a huge 0% earnings growth crowd. We have a earnings recession crowd that's out there, meaning 2 consecutive quarters of negative earnings growth potentially for the United States in 2019. And so if you are in that crowd at 0% earnings growth with the S&P at 2,700 and change right now, that's a pricey market. We're at close to 17 times forward earnings, and those of you who follow this, and Marianne's one of the experts of the world on this, 0% earnings growth at 17 times forward earnings, that's not a good combination. Historically, that's a very pricey market. So, Marianne, could you give us a little outlook on where you see earnings this year and the role of the Fed?
Sure. Thank you very much. And I would agree with you if your scenario was right, but I have a different scenario. So we do our year aheads in November. And in November, we actually wrote that we saw earnings contracting. We saw earnings growth rates going from 23% to 5%. And we're sticking with that. We're not at 0. We still see the economy growing, but slowing. For 2 years, the economy grew above trend. Now we think it grows at trend. And what a lot of people are not watching is wages are finally starting to get a bid. We're starting to see wage growth up around 3%. That should be good for consumers' confidence, even though we recently had a dip. And that should, in turn, help consumer spending if we're right. And that will allow earnings growth to slowly turn around. So we don't think it's that dire. We did call for a baby bear. We do believe the baby bear is done. And you know, we're not looking for a big year. We're looking for the S&P to close around 2,900. But we think the bear is completed.
A little bit more on that. Maybe you can expound on this a little bit, Todd, your thoughts on where we are on earnings situation? Because I think that's going to be the dividing line. I really want to address the global growth issue, and feel free to impact that. But with 40% of the profits of U.S. corporations outside the United States, we really can't ignore global growth when we talk about the earnings impact at any rate. So feel free to layer that in.
I think Marianne and I probably are arriving at similar numbers on EPS estimates. I think it's reasonable to expect maybe a 5% global growth, and yes, that's been falling rapidly for a number of months. I think what's important to note as we sort of face out moving forward is going to be how do you position yourselves in an environment where you have trendless growth, right? Where you have trendless growth, it's difficult, I think, to make those kinds of calls, Bob.
Trendless growth. I want to just make sure that Todd's mic is working okay. Well, let me move on about the trendless growth then, and get some other thoughts from everyone. Gene, maybe you can expound on this a little bit.
I would love nothing more. So when we talk about equities and when we talk about global equities, global growth, we should be thinking about obviously the trend, so magnitude and direction. When I'm thinking about the U.S., yeah, it's been high recently. We think it's going to come down, and we think that will converge with parts of the rest of the world which are going to come up. So I want to be talking about global, not just U.S., and ultimately I want to be thinking about how that global growth works into inflation and interest rates as well. And that's been touched on a tiny bit here. So yeah, there's a bit of wage inflation creeping in, but we see inflation being relatively moderate over the next 12 to 18 months. And that's different than our position last year where we thought that inflation could be a pretty big deal given wage growth and energy prices. Those two things have kind of come down. And then of course the Fed policy, and not just the Fed, but the ECB and the BOE and the BOJ and the PBOC, all these central banks and their policy towards potentially tightening or loosening liquidity, that's kind of a big deal too. And we can't ignore that as we're thinking about growth and we're thinking about what happens with US markets and non-US markets too.
So Yuri, the earnings growth is slowing, even in the emerging market area, and perhaps you could hit on that briefly. But we did have a pretty rotten December. A lot of people are trying to argue whether it was a December low at that point. There's obviously a lot of bad news priced in, but we've sort of come back. I guess give our RIAs out here some advice on, was December 24th the low that we have seen, or are we going to see rolling challenges? And if so, where are they going to come from?
Yeah, well, as Marianne was saying, I do think that the mini bear, if you want to call it that, probably the low was in on Boxing Day, December 26th, 2347 on the S&P. That brought the S&P down to a loss of 20.2%. So it met the bear market threshold for a New York minute, basically. And we saw major capitulation. It's unfortunate that people still do this, that investors still do this, but for the month of December, investors sold $83 billion worth of active mutual funds in the equities, but also ETFs combined. That is a record according to EPFR, which is a data aggregator. So investors locked in a 20% loss, only to see the S&P go back up 16% in 5 weeks. And as a technician, I've seen that story at basically every market bottom. And so the way I look at it, when you combine three things, a 20% capitulative bottom, a Fed pivot, and of course the Fed did pivot about 2 weeks ago, and the lack of a recession, and of course we don't know in real time whether we will have a recession down the road, but I don't see any evidence of it. So when you combine those three things, you create actually one of these mini bear type of analogs, 94, 98, 2011, all three of those cycles. I mean, 94 only saw a 10% decline, but 98, 2011, 20% declines, a central bank pivot of some sort. In 98, it was the Fed. 2011, it was the ECB, and no recession. And in all of those cases, basically, the market recovers very quickly. Having said that, I think at this point, the market's running out of gas, and usually those big V bottoms see a retest down the road, a few weeks, a few months later, maybe a 50% retracement. And I think we're actually in the beginnings of starting that retest.
I know you're a technician, but are you in that 0% earnings? Because that's the dividing line. When I talk to the strategists and analysts, you're either on the 0% or below, or you think you're, Marianne is in the mid-single digits. That actually makes a difference in terms of the valuation.
So what the market believes, so we saw 23% earnings growth last year, 26% was the quarterly the annual growth number for the third quarter. We're down to 13% in the fourth quarter. The consensus is for -2 in the first quarter, plus 1.8 in the second, plus 2.8 in the third. So the market sees the dip, but then the recovery. And I think the market will see through the dip if it believes there's a recovery in earnings growth back to 10%. Like the consensus number for 2020 is 11%. For 2019, it's actually down to 5. Yeah. It was 12 just a few months ago. So at this rate, given the normal progression of estimates, we're lucky to get low single digits, but the market always looks through that. So if the 2020 rebound doesn't happen, then we're in an earnings recession. But 0 or 3 or 5 coming off of a 23 markets, I think the market will look through that.
The problem I've got is that it's all back-end loaded now, and the fourth quarter is notoriously murky when viewed from the first quarter. Those numbers are not terribly reliable. So if you've got the fourth quarter where the lot's riding on whether you're going to be positive or negative, and you got a murky year, it's a tough call at this point. Brendan, let me turn to you. Brendan is the China expert here. He runs, CraneShares runs several very interesting China ETFs. I wonder if you can give us your outlook. You go to China a lot, and maybe you can give us a perspective on how the Chinese are viewing, first off, global growth, but more importantly, a little on this whole trade war issue. Can you offer us any perspective on how the Chinese might view the negotiations that are going on trade here? And not just, I mean, they obviously know that this is not really about buying soybeans. This is a lot about technological transfer, software theft that's been going on for a long time, very difficult long-term issues. Give us your outlook on China this year and a little bit on what you think the Chinese think of the trade negotiations.
Yeah, on the trade war, it's interesting. The Chinese are somewhat surprised by the administration's definition of trade, that the president's view is if something's made in China and is put on a boat and sent to the U.S., that's a Chinese export. And the Chinese would say, well, there's a lot that falls outside of that. Services. Chinese companies bought $50 billion of services from U.S. companies. That could be accounting, investment banking, consulting. That doesn't show up in any trade data. Also, what doesn't show up are the tens of billions of dollars of Apple iPhones sold in China, the 4 million cars that GM sold in China. Because they're made in China and sold to Chinese, they're not considered a U.S. export to China, even though all of those revenues flow back to Cupertino and Detroit. So the Chinese have been somewhat surprised that this definition of trade is not really up to speed for 2019, as well as understanding how U.S. multinationals own these factories in China and the U.S. consumer benefits from the lower cost. So they've been somewhat surprised. I think we sat down with Dr. Henry Kissinger a few weeks ago, and we've published our meeting notes with Dr. Kissinger on craneshares.com. And his view is that the administration's tactics are unconventional but effective, and that both sides want to see a deal get done because it's in both of their interests. So obviously this week we've got both Steve Mnuchin and Robert Lighthizer in, and there is the view that a deal will get done because as much as China's economy, their export part of their economy has slowed, it's also now affecting U.S. companies, U.S. multinationals. So I think things do get resolved, and ultimately we'll be in a better place because of that, because of addressing a lot of the long-run issues in terms of IP and joint ventures. That's very likely going to go away.
I want the whole panel to feel free to jump in at any time. I don't want to have to call on you guys if you have opinions or thoughts.
I've got audio. It works.
Go ahead.
Well, yeah, to finish the thought I was making there, and I do agree, the foreign direct investment, I think, is what we're talking about, right? The scope and size of the foreign direct investment market, I think, is critically important to realize. I mean, you're looking at about 2 to 3 times the accumulated capital that's been invested from the U.S. overseas at about $6 trillion versus what you see from the import-export market. It's obviously a different sort of animal, and it is accounted for differently. Encouragingly, we do see FDI flows remain strong. There is opportunity to continue to think that actually focusing not across the Pacific, but actually focusing across the Atlantic might be a more interesting way to focus on that. The U.S. investment in Europe, I think, is in fact critical to evaluating the overall robustness of global commerce, as is the import-export market.
Yeah, I agree with Brendan's analysis, but I think the Trump administration sees it in a very different light, and I could see how the Chinese would be puzzled by that very easily. Go ahead, Yuri.
I would just add, I mean, we're all talking about trade. I think actually trade is not the most important thing when it comes to the global picture. China is. China is really the key thing. You know, in the U.S., there's really almost no signs of a recession. The only way anyone was able to predict a recession maybe in 2020 was by extrapolating the flattening yield curve, and you know there's a lot of if-thens in that logic. But you know, China is growing, is slowing significantly, and it has been well before any tariffs were placed. And the problem in China is they don't want to go back to the well of more direct fiscal stimulus. You know, these days, if you're running a local government or an SOE, if you are doing a new project, you're actually on the hook for that project, I think for your lifetime or your career. So this is an anti-corruption thing. So there's very little going on in terms of credit growth. Monetarily, they only are so able to pull levers because rates are already low and they would go below the US if they keep going, and that puts the currency regime kind of under pressure. So I think the ability or lack of ability for China to reflate their policy, their economy, is probably one of the most important things in 2019. And trade is part of that, but it's only, I think, a relatively small part of that.
I would agree with that. Crane actually sponsored an event and invited me to where we had the opportunity to meet the economist from CICC, which is the largest investment bank in China. And the rate of slowing, if you look at it, is staggering. And the conclusion is they're still working off their infrastructure bubble. But the economist said that there's a lot of internal debate on how to deal with the slowdown. There's no commonality. But I wanted to get back to the central banks. You and I have been around for a long time. I remember when the Fed was on hold or cutting, the ECB was on hold and cutting. China's certainly not tight, probably needs to be a lot easier. We call that coordinated central bank intervention. Yeah. And what's really happening, which is astounding 10 years after the financial crisis, is that we're still growing very, very slowly. And yes, the US has tightened, but we've gotten to a point where there has to be more accommodation in order for our economy, Europe's economy, and China continue to grow. In fact, there's risk in certain countries that you might even see a recession in Europe. And we've never seen this before. And what I really encourage our clients to look at are global interest rates at the developed level. And when you look at the 10-year, Switzerland is already in negative territory, Japan is at 10, and everybody else is in between, but the US is at the top. Normally when you have a high interest rate, you're a major risk. I don't think the US is a major risk. More staggeringly, if you look at the 2 years and you look at the developed sovereigns, half of the rest of the world is it's below zero, it's negative. And I think people are underestimating how hard it will be for US interest rates to go up on a global scale because of how low rates are around the world. And it's a totally new regime for monetary policy. And if we're going to have central banks that are a little bit more accommodative, I think we're also underestimating the power that it will have for earnings. Yeah. And the PE multiple, that I don't think, we still have to get through maybe another government shutdown, we have a debt ceiling that we have to deal with, but at the end of the day, the US is the prettiest house on the ugliest block. I still think that there's a lot of potential for our economy and therefore for earnings and then for the stock market to go up.
So Jean, increasingly dovish central banks you've been talking about before, what Marianne was talking about, the U.S. is the best house on the block at this point. Riff on that a little bit.
Yeah, a couple comments here. First of all, I respectfully disagree that China is the big issue. If you're thinking about macroeconomics and the geopolitical impact of it onto markets, I'm not sure that I would say that China is it. And I'm not sure that I would say that trade tensions are it either. I think that there's a lot of uncertainty in terms of what's going on with the trajectory of growth generally, and especially the difference between the US, other developed markets, and the emerging markets. So when we're thinking about what does drive equities, because this panel is all about equities, although I'm hoping to take it a little bit further than that. But if we're talking about what drives equities, primarily GDP growth expectations have a pretty tight connection with what moves equity markets. Not necessarily China's GDP growth, not the US GDP growth, global GDP growth. And we see that converging to a lower number for the US, but potentially higher numbers elsewhere. And part of that is because last year and the year before, the buzzword was all about there's a synchronized global growth deal, right? That synchronized word is kind of key. Clearly, we're desynchronized now, and that desynchronization means that we, the US, we're in a different part of the cycle than the UK, than Europe, and then China. And I'm not sure that if I were a central bank policymaker, that I necessarily want to align regimes with others, right? I'm kind of concerned about what's going on within my country, trying to figure out what I should be doing with interest rate policy to balance out the threat of inflation and employment, kind of an impossible task. And so if we're talking about central bank policy and how I should be setting interest rates, part of me is thinking about what happens when I need to cut and at what level can I cut from. So last year, it looked like we were having an increasingly tightening regime on our hands. That's changed over the last couple months, but I'm not sure the market has quite priced that full turnaround in. So I think perhaps right now the market's happy. It's thinking, hey, dovish policy, maybe there won't be any more cuts this year. I think that's wrong. I'm sorry, hikes this year. I think that's wrong. I think that there will be more hiking in the US this year, and that impacts not just our interest rates, but our currency. And when that impacts the dollar, then you're talking about trade again, and you're also talking about potentially the attractiveness of emerging markets versus the developed markets because
and you
of the
think
currency
that
implications.
we could get hikes because the U.S. economy will hold up well and the Fed's data dependent and they'll simply act on that?
Yeah, from what my teams tell me and from what I see, the US economy is still relatively robust.
Yeah, that's still going to keep rates low, though. And Marianne's point here is what U.S. Treasuries, 30% controlled by outsiders. I mean, every time rates go up, they buy, and that keeps rates down. I mean, it seems pretty obvious to me. We keep pointing that out. It's like obvious supply and demand in the world. You're 0.3% on the 10-year in Germany, right? And you're 2.7% here. That seems like a duh. You know, if you're looking for some yield.
It's important to point out, Japanese institutional investors or European institutional investors will not buy US Treasuries unhedged. So once you hedge out the currency, you know what the 10-year Treasury yields? Minus 0.2%, even though the nominal is at 2.65 right now. So we are the highest yield of any developed major country, but it's all about the FX hedging. So foreign investors get nothing, at least nothing additional to what they can get in their home market. And that's one thing that's keeping our rates anchored at higher levels than otherwise might make sense.
I think, too, investor behavior ought to enter into this discussion as well, meaning what we've seen since the global financial crisis has been a steady appreciation of risk assets with below average volatilities, right? It's been a relatively easy lunch. And I think that's meant that investors have gone places to reach for yield. They've gone places to reach for return. They've essentially exposed their portfolios to volatilities they don't typically carry. Last year's 19% peak to trough move on the MSCI ACWI doesn't seem all that abnormal when you consider 16's average, right? I think in many ways, investors in risk assets, whether that's equities, credit, emerging markets, spreads, getting used to the more normal level of volatility will likely cause changes in investor behavior.
Yeah, so we're going from high return, low volatility that we've seen to low return, high volatility.
It's a year of poor Sharpe ratios. I think that's what you're going to get. You're going to get some low levels of return from most risk asset classes. That's where we are, coupled with a denominator that looks much larger, and I think that's tougher.
I think the one thing I'd point is that since the March 9th, 2009 low, U.S. equities have gone up almost 400%. Broad-based emerging markets has gone up less than half that. And I'm not necessarily think anyone should be bearish on U.S. stocks, but I think we're running into some structural headwinds from a valuation, from a historical valuation. At the same time, emerging markets are relatively inexpensive. They're below their historical averages. And what I think is important, being at an ETF conference, is investors plowed $30 billion into broad-based emerging market ETFs. 25% of that exposure is in financials within emerging markets. Another 20% of broad-based emerging markets is in energy, industrials, and materials. So I think, as investors, we have to find global growth, and that may or that will still continue to be part of the U.S. But as we look increasingly at emerging markets, I think we have to be a little bit more discerning in terms of making sure that we're actually capturing the growth engine within emerging markets. And for us, it's really about the consumer at CraneShares. We've seen that in China. I think we're still consider China as an export-driven manufacturing. 50% of the GDP comes from the service sector. We're seeing the Chinese consumer is alive and well. And I think that's true not only for China, for broad-based EM, that if we buy the blob, we're not really capturing the growth drivers that are taking place in the emerging market.
Would you include technology? I mean, you run a tech fund, a Chinese tech fund as well, the internet fund.
I think for ETF investors, these indices are very, very important. And tech, what was tech is no longer tech, right? We've had these global industry classifications. Now, a lot of tech is now communications. Telecom is gone. And so for us, we've always been focused on a bottom-up approach, looking at subsectors, looking at ways to identify companies that are the transmission engines for that. And these GIC changes, it's a big deal. And yet there's still nuances. If you're an online employment company, can anyone guess what sector you're in?
Communications.
Industrials.
Oh, yeah, they stuck them in there.
And so that's where I think as passive investors, we need to study these index.
That makes no sense to be stuck in.
It is zero.
And by the way, one of the reasons
I would not have guessed that.
One of the reasons EM is so much cheaper than the U.S. is it's because it's allocated to sectors that are historically always cheap, energy, financials. So it's only one of the reasons,
right.
But EM is not quite as cheap as it looks when you re-rate the sectors to make it look like the same composition in the US.
Well, I always think of the RIAs that are out there that have to go home to their clients and explain why they have weightings in certain areas of the world. So let's give them some advice. You guys are so brilliant. Tell them what to do. So on a relative value basis, can you make an argument for emerging markets overweighting this year?
Yes, I can.
You can.
And the reason I can, and I couldn't say this last year, is it has to do with currency as well, right? When you're a U.S. investor investing in emerging markets, you have to look at it through the lens of currency, period. So there have been changes in currency differentials between U.S. and other emerging market currencies. That's helping. As U.S. growth slows, potentially EM growth increases. That's helping also. And talking about like the most pretty house on a crappy block, right? That's where the U.S. is. EM probably isn't that far behind. I can think of much crappier houses out there. So if I had to choose, right, if I have choices amongst asset classes and amongst equity investments, I've got the US, got Canada, which we don't need to spend a lot of time talking about, Japan, Asia ex-Japan, emerging markets, and Europe. I can make a trade saying, hey, maybe I should lighten up on US and go a little bit heavier in EM for all the reasons that I just listed.
Now, Brendan, should we talk about emerging markets ex-China? Does that make sense? Because it seems, are they so important that they essentially suck in Asia emerging markets completely?
We've actually filed for EMX China, but part of that is because China is so much bigger than the rest of EM. There's hundreds of Chinese companies. There's like 450 Chinese companies out of the 1,100 stocks in EM are Chinese. India is less than 70. Taiwan's like 80. South Korea is the #2 country. That's 114. So numerically, China's 4 times bigger. But it's also important, what's your exposure there? It is very heavy in terms of China and broader EM to banks and commodity plays. I still believe these aren't the growth drivers. That's where we've been very focused at CraneShares in capturing. But China's only going to get bigger because of changes coming with MSCI, FTSE, and Standard & Poor's.
This is one of the things I keep telling people. You may say, I don't want to own China, but if you own an international fund the chances are you're going to own a lot more China in the last few years, partly for what you just said. It's just slowly keeps creeping up. It's going to be 30% of EM?
30 today.
EM?
Yeah, and remember, the U.S. is 25% of global GDP, but the MSCI U.S. index is 54% of the MSCI all-country world. So if that changes over time, that doesn't mean the U.S. stops outperforming from time to time, but it does argue for a more global approach to investing.
Yeah, I mean, an all-country world investor has twice the exposure to Japan, even though their GDP is half the size of China, and you have as much exposure to the UK and France, even though their GDPs are 1/4 of the size.
And there's an issue with EM definitions that include Korea or don't, right? That's kind of a controversial thing. So depending on which index provider you're with, either Korea's in or it's out, and that makes a big difference if you consider Korea a developed market or an emerging market.
I just want to finish up the emerging market and stick with let's give the people watching some advice here. Just go down the aisle here and give us your thoughts on emerging markets, overweight, underweight, poor performer. On a relative value, it's underperformed the last several years, but
It has, and when I agree with the comment, you know, you have to watch the currency, but you also have to watch interest rates. And when you have a Fed tightening and you have a stronger dollar, emerging markets don't do well. You have the Fed on hold, you have a weaker currency, emerging markets do well. And if you look at the technicals, it looks like the emerging markets have bottomed out.
Todd?
And you have the valuations.
We're underweight emerging markets today, and I expect that position would stay in place. I think there's some reasons for optimism maybe on the debt side, but I think I'm a little less bullish on EM currencies than most. I think you've seen the volatility of EM currencies recently come down. If the U.S. actually gets its 1, maybe 2 in the back half, I think that's enough to provide the strength for U.S. dollar to stay strong.
Gene, you're overweight, right?
I've already said my piece, yeah.
Okay, yeah, and obviously we know where you're at over there. You're in?
You know, EM underperformed by 20 percentage points last year, and that's been cut in half now because the U.S. has did roll over. I would not want to be underweight EM after that kind of underperformance, especially now that the Fed has pivoted, allowing for the dollar to come down, which, you know, as everyone said, that greases the wheels for EM to function better. You know, China has been slowing. I think they're going to be more aggressive in trying to reflate. So I would want to be, you know, certainly considering an overweight here.
Yeah, I would agree. Just on a relative value basis, the key is the dollar, though. The dollar, that's always a major problem. I want to pivot to Europe and Brexit. We had the EU bringing down growth forecasts last week. We had the Bank of England in the you know, slit my wrist mode, really depressing commentary. EU essentially has Italy at 0 this year. So I guess we're back to this old question is, we've got the ECB, you know, in prime stimulus mode for years now, and basically we're flat to 1%. What's the problem with Europe? I know this is one of those 20,000-foot questions, but you know, give these people here some insight on why we're so stuck.
Yeah, I mean, the economy has actually done okay. It certainly has slowed along with the rest of the world. It's just you have these structural problems, whether it's Brexit or Italy, and that's why Europe is always cheap, and maybe it always will be cheap. It's because ultimately, you know, coming back to valuation, it's how much are investors willing to pay for each dollar of earnings? And in some countries, it's 16 or 17 or 18, and in other countries, it's 10 or 11 or 5. You know, I think Russia's trading at about a 5 or a 6.
And why are they willing to pay 16 or 17 in some countries and 10 in others?
Because the stability of earnings growth, right? If you look at the discounted cash flow model, you put earnings growth in the numerator, sustainable earnings growth. You put cost of capital in the denominator, or broadly defined in my book as sort of liquidity conditions, financial conditions. And if you lack stability or sustainability in earnings growth in the numerator, it's going to spit out a lower fair value and therefore a lower PE. So I think that's what it comes down to. And it's just there are too many structural issues. You can blame it on, you know, the European Union system or whatever, but the bottom line is that nobody's going to pay up for earnings if you have those kinds of structural headwinds.
Marianne?
There's one other structural issue I think Europe has, and that's their banking system, is they never really address the insolvency of the banks. our banks are much stronger. They still need to strengthen their banking system, and I've always believed that your banking system is the heartbeat of your economy, and if you don't have your banks really up and functioning, your growth rate is going to be very slow.
Why are we stuck? This is even further than 20,000 feet in the air. This is 50,000 feet. But why are we stuck globally in a low growth environment? The capitalists are wringing the hands. Some are saying, oh, well, this is a feature of late stage capitalism now, and we're really going to have problems. This is why you get, you know, the people out, the strong men out screaming that they have solutions when you have slow growth or no growth. Hardcore capitalists will argue over-regulation's killing everything in Europe, and the lack of a real big banking system is. But does somebody want to just expound on, I know this is a...
It's debt and demographics, right? I mean,
yeah, Yuri, and you like talking about these broad philosophical questions. Why are we stuck in slow growth?
you have high debt levels, aging demographics. You had, the whole populist thing about globalization not, providing benefits equally to everyone, that there's winners and losers, and monetary policy was exhausted, and we're seeing that because now the response is fiscal and political. But it's just, it's the Reinhard Rogoff, story of you run up very high debt levels while your population, potential GDP is growth in the labor force plus growth in productivity. That's it. And in the U.S., it's like 1.5 to 2%, and has been like that for years. So when the economy is actually running at 3.5, in theory, it becomes inflationary. The Fed has to step on the brakes, and you cannot have that kind of 1950s era run rate of 5-10% nominal GDP growth anymore.
Yeah. Hard to get your point about population growth. I keep pointing this out to the anti-immigration crowd. We need people coming into the country. Italy is becoming Japan.
It's free GDP. Bringing people
Italy
in.
is it's below 0.8 babies per household. Japan's effectively negative. How do you have the economy grow? That's all you need to know. You don't even have to be a professional economist or technician like you are. Nobody's having kids. The population isn't going to grow. It's hard to get the economy growing unless the people who are in the economy themselves start spending more, and that makes it difficult with more limited wages. It's not that hard to explain.
Mm-hmm. I hear what you're saying. It's not quite the Nikolai Ceausescu model where like more people equals more productivity all the time. But I would agree that an injection, yes, of more human capital in the production would be worthwhile. That's true. Go ahead.
I'm just going to say this. Sometimes it's not even more people. It's using the people more effectively, right? So in other economies, and maybe in the U.S. also, getting more folks in the workforce, getting women in the workforce doing productive things would be a huge boost to the economy. I think that's especially extreme in Japan. So again, aging demographics, but also if you look at labor force participation rates between men and women, there's some pretty stark differences there too. And you have to ask yourself, is it easier to convince a country to convince their population to have more kids, or to have immigration come in from elsewhere? And I don't think we necessarily want to get into the politics of that, but as an economist, there's only two sources of labor force participation, right? Either your economy grows organically, or you have people come into it. And if you look at high growth periods throughout history, from like the 1700s on, you see that there's a relationship between what the labor pool looks like and what output looks like.
My only thing is, are we going to need as many people? It sounds somewhat dire, but
are we going to need as many people?
With robotics and technology, I just don't know with electric vehicles. I mean, how many hundreds?
Are you volunteering to go?
I'm not. I think I got a little more time. But I was in Beijing not too long ago. No security guard, no security desk. You walk up, facial recognition, the thing spits out your pass. Either you have, if you got to be in the guest system. We talked about, David was talking about, the largest mutual fund family in China is Alibaba. What happens when electric vehicles, what's that going to do to truckers? I think that it's creating problems because it's a world of haves and have-nots, and maybe some of the populism that's taking place is part of that. But if you have robotics and automation, I don't know to the degree you're going to need as many bots.
This is a very broad, different kind of question. I don't know if you've read Harari's new book, 21 Lessons for the 21st Century, but he specifically cites the useless class. I mean, it's pretty startling when he actually says this. Like, there's vast numbers of people that don't really have any purpose in the modern global economy at all, and are going to be completely, zeroed out of the global economy. It's a really startling word, like the useless class. But I agree with your point earlier about not just growing the population, but using existing human capital better as a way of helping the economy grow. That's a very important point.
I think that's the pathway to, if there is upside, I think, we have been talking a lot about economics versus markets, but on the economic side, if there's a pathway to more growth, I think it probably comes from business spending and productivity gains. I think that's where you could see it. Yes, a little more human capital helps as well, but there is room, I think, for business capital spending to continue to move forward, and then that to kick off more productivity, and that to kick off more earnings. That virtuous cycle can go further.
Yeah, and those of you who want to, my favorite book last year was Harari's book, 21 Lessons for the 21st Century. If you want to see what a global thinking about the future of mankind near term is on a big 50,000-foot level, that was my favorite book last year. I want to move on. I got a couple questions from the audience, but just on Europe, again, some advice: underweight, overweight Europe, and Brexit, does it happen or not? I just want to move quickly through here. Anybody have any thoughts, advice you're giving these people here on overweight, underweighting Europe right now?
You can avoid it.
Well, that's pretty dismissive. I'll let the Italians know you feel that way about them.
I love their food.
Oh, great. They don't like you that much. All right.
I think there's better value in other places around the world relative to the growth trajectory you got.
Another country
See,
you
you
heard
were
from.
nicer.
There's a bunch of depressing people over here. Go ahead. Say something optimistic.
So looking at the trade between Europe ex UK and UK would be underweight Europe ex UK, overweight UK. Maybe that's a contrarian view given what's happening with Brexit. I actually do think it's going to work out. Not sure how yet, but I don't think that they're going to make a foolish mistake. We'll see. Maybe I'm wrong.
I'm agnostic on Europe, other than a great place to vacation.
Thank you. The Italians love you.
I think the dollar is coming down. So Europe on an unhedged basis could very well work. But I think there will be some Brexit deal, maybe a Norway plus, that sort of thing. But I think Japan is actually more interesting. It's funny how nobody talks about Japan, nobody cares. So I think Japan could be like the sleeper hit because it's not expensive. The economy is actually relatively stable. They're actually producing a little bit of inflation for a change. So if I had to choose Japan versus Europe, I would pick Japan. But generally speaking, US versus the rest of the world, I like the rest of the world here.
I would take a question from the audience, which is an interesting one, which is, when investing in overseas, should I routinely be hedged or unhedged generically? What advice would you give everyone? On currencies, obviously.
I think it depends what your liabilities are denominated in. If you're a U.S.-based investor...
Yeah, let's assume that.
Yeah, if you're a U.S. investor with U.S. liabilities, why pay all the hedging costs? I mean, my sense would be no. I think you would leave it unhedged. I think that's a far easier way to gain the kind of beta exposures that come from those currencies anyway.
I would take the opposite position there. So I'd say if you're a U.S. investor investing overseas, you want to disentangle the currency risk from the risk of the asset class. Right? And maybe that's wonky and academic, but I want to make a bet on an economy, not on the currency. I can make a side bet on the currency. So I would have a portfolio that's 100% hedged back to US dollar, and then be thinking about where my currency trade may be. So my currency trade doesn't necessarily need to equate with the capital that I'm putting into an overseas economy.
So in a previous life, I managed a global portfolio, and I traded currencies. I overlaid them on a portfolio. There are times that they work, and there are times that they don't work. There's an expense to hedging. You're not wrong to hedge. You're not wrong to unhedge, but understand that you will have volatility. The other thing, I'm just going to give you the third answer, is you hedge half of it and let half of it run.
I would just add, hedging by definition, equalizes the performance differentials, and especially in a highly efficient global capital marketplace, if you are hedging all the time, you're not going to get the rewards by taking the additional risk, so you might as well just stay in your home country. So generally, at Fidelity, we do everything unhedged, and if your horizon is long enough, which it probably should be, then the currency aspects kind of fade away and the earnings differentials come to the fore.
And there's a big, for ETF investors, the hedged ETFs, if you're right, those hedges expire and you lock in the gains, and that shows up as capital gains. So there is a tax consequence, even if you're right.
There's a whole bunch of China questions here, and Brendan, maybe you can answer them. People are asking, a lot of the companies I want to invest in are domiciled in China. Should I be concerned about that at all? I think they're probably referring particularly to state-owned enterprises, number one. Number two, I always get these questions about how can we believe the China data? So we have 6.6% GDP numbers. Every time we go on the air and report China says their GDP grew 6.6, we get emails from people saying, oh, it's all crap, Bob, you know, they make it up. It's like a Ouija board over
by the
there.
way, do you know where that 6.5% comes from? In 2010, there was a mandate to double the economy in 10 years. When you calculate the IRR of that, it's 6.5%.
Okay,
That's where that comes from.
Okay, well, Brendan, you've had this question many, many times.
So, and I think
how real are the
Chinese? I think the important thing is, one is, you know, as investors, what do we want to be geared to in China? Like, do we want to own 50% banks? I don't think so. I think, you know, one, you want to focus on the consumer, and so what's with the state of the consumer? Chinese retail sales went up 9% last year. That's from the National Bureau of Statistics. Okay, so that's the Chinese government agency saying. How can we believe that? Okay, well, Alibaba just reported earnings. They grew 41%. Okay, that's a Chinese company. How can we believe that? They have because they're listed here in the United States, they have a US auditor, they have to adhere to US GAAP, as well as the listing standards of the New York Stock Exchange. But what if you still don't believe it? Okay, well, look at LMVH, look at Diageo, look at Starbucks, look at the consumer-geared multinationals doing business, and contrast that with, say, Caterpillar. You know, Caterpillar is kind of geared to old China, you know, building infrastructure, and not surprising, Caterpillar slowed. But if you look at the consumer is where we as investors want to be invested, not only in China but in broader EM. And so I think the numbers you can believe them. I think there is a willingness that. You know, MSCI has given China this opportunity to bring the mainland markets into their indices, and you have to abide by, you know, the adult rules if you're going to be part of that game. And so I think there's been a strong evolution in China to adhere to global standards.
You're sort of moving the terms of the discussion a little bit. I was asking about, referring to the economic numbers, not the corporate numbers. So let me just go to the economic numbers. So I'll give you my sense of this. The companies that are out there are different, I agree. But when you're dealing with the national numbers, so 6.5% on the GDP number, I don't think that there's some mandarin sitting in the Department of Economic Statistics saying, well, the actual number is only 4.5%. We can't do that, so I'm sorry. It's going to be 6.5%. I don't think that's happening. But look how the numbers are actually compounded. On the lowest levels, when you have this regional officials that out there that we all know are incentivized to do well, that's where I think you can get inflation very, very easy in the numbers. And it'd be almost impossible to identify. So you've got a guy running a small regional town outside, 50 miles outside of Guangzhou, and you know his numbers feed into the economic number. That's where I think you can get the kind of inflation that we're.
I think, you know, China, parts of China are incredibly rich. I mean, there's parts of China that it's like being on Rodeo Drive. And then you can go into the hinterlands, and I've been out there, and it's very poor. And I think even an element of the trade war is China rich or is it poor? And it's a little bit of even China itself trying to grapple with that. But I think the trajectory is there, and there's a willingness on their part.
Okay, we got 2 minutes left. This is the final little comments on how we do this year. This is an equities panel, so let's give us quickly your view on, let's do U.S. equities this year, S&P 500. Let's make it simple. We're going to be higher or lower, or are we going to see, is there going to be any point in this year where we'll see the kind of volatility we saw in December? So just two questions, higher or lower at the end of the year in the S&P, and any chance of the kind of volatility we saw in December?
I think we have volatility, but not the kind that we saw in December, and the market's higher.
I'll go with markets slightly higher. You can't expect the plus 7%, up 7% that we saw the last couple of months, but surely I think you're seeing more volatility. I think looking at equity markets, you expected some action there. I think it's worth talking about fixed. Again, this is an equity panel, but relative to what you can get on a risk-adjusted basis, I think that some of the up-in-risk fixed income choices merit some discussion here too.
We got so many emails from people who said, my mother's getting 3% in her CD this year, and it outperformed the stock market. And when was the last time we had that happen? And we had to do we did a whole thing about that. Last time, you saw an outperformance, cash outperformed the stock market. It was a notable thing. So I think you make a good point. Gene?
Yes, so I think equity markets moderately higher, volatility, yes, it's finally back. I'm pretty excited about it. I think we've had abnormally low volatility. It's time to kick it up a notch.
I think follow the flows, be part of the rebalancing trade out of U.S. equities into emerging markets, and particularly with this index inclusion coming up, that's going to be very geared to China.
The last time cash was on the top of the leaderboard of all asset classes was 1981, when it produced a 14.7% return. So the fact that it produced 1.7% last year and beat everything else is a testament to how low risk premia are among all long-term assets.
And of course, that was the year or the year before the Fed broke the back of inflation, 1981. I hope that this has been informative. I try to push this point of view of educating the RIAs out there about what they can tell their clients about how to invest. And I hope it's been useful for all of you. Thank you very much, Marianne, Brendan, Todd, Gene, and Urian. Thank you very much, and thank you all for attending.